Hey everyone, welcome back to another episode of the Integrating Investor. I'm Seth Levine of the Integrating Investor website. Thank you for joining me again. Welcome back, as always, on this lovely Friday, as we are heading into the holiday seasons, which I personally love. If you can, try to extract away any facial bruising that you see on me. Had a little bit of a rough go this week on the mats, but all in good fun. Learned some stuff. This week, we are going to continue last week's show that was on gold that unfortunately we didn't get to kind of wrap up. So we're going to do that today. And then next week, we are going to wrap up the season. This will be the real last show of kind of content. I'll talk about next week's show at the end of today. As always, please like and share this episode. It helps me a lot. Thanks for everyone who tuned in last week. That got a fair amount of likes. Thank you so much for that. I hope those reflect the value that you got out of it. Hopefully we can duplicate that today because it's an extension. Also, you can follow me on Twitter, Instagram to a little extent. Check out the website. That's always the best spot. And if you subscribe there, you'll get my monthly emails. And as always, we have that super chat function. Please feel free to use it. Ask questions on there. I like to make this as interactive as I can, and super chat's the best way to get my attention. And as always, feel free to email me at any time, any show topics or guest suggestions at info@integratinginvestor.com. That's info@integratinginvestor.com. Kicking off, MA, thanks a lot for the super chat. Thanks for kicking things off. Hopefully I'll be able to live up to the expectations there. So moving right along, always the best part of the show, we will go to the disclaimer. Again, these are just personal opinions, should not be construed as investment advice, recommendations to purchase or sell any investment product, service, or should you rely on anything I'm about to tell you to make an investment. We're talking about gold, and as I mentioned last week, I own and control accounts that have gold and gold related investments in there. So I am maybe I'm talking my book, maybe I'm not. You should just be aware that there may be some kind of conflict of interest there. All right, so last week we talked about gold's ability. We not only did we just talk about gold, we specifically talked about its ability to hedge inflation. Contrary to popular belief and lore, if you will, gold's been a pretty poor inflation hedge over the last 50 some odd years. Now, this is due to definitional changes or definition changes to both gold and inflation. So gold no longer plays a role in defining monetary value, and because it doesn't play that role, it cannot perfectly hedge inflation anymore, right? It can only perfectly hedge inflation when it plays a role in defining a monetary standard. Also, the meaning of inflation has changed over the years. Inflation today means some kind of CPI growth or CPI-like instrument, like the PCE or the PPI or all that alphabet soup of inflation metrics. But inflation doesn't mean monetary debasement anymore, quite simply because we live in a fiat currency regime. And in a fiat currency regime, there literally is no monetary standard, right? It is a subjective regime. Now, that doesn't mean I don't think fiat currency is harmful. I do. I just think in different ways than as popularly discussed. So today, what I'd like to do is really drive home that point with an example or two. And I want to hammer it really hard because this is really important in my view. This not only is important for investment portfolios and gold's role in investment portfolios, but it illustrates the importance of definitions in real life. right? We're not just defining and discussing definitions for semantic reasons or to pontificate, right? These aren't mental gymnastics just for the sake of it. There are real world consequences of how we define our concepts and how those impact our actions. So here specifically, we're talking about gold and investment portfolios. So let's drive home this point about gold. When we have an objective monetary standard, right? Objective meaning it's defined and you could see it's defined, and we could all see it's defined as the same thing. Now, we may not necessarily agree that that makes sense or not per se, or whether or not we agree with the value of it, but we can all observe that we can all observe the definition. That's what makes it objective. So let's say, and what I mean by that is, at one point, $35 was tied to an ounce of gold, right? That's how $35 was defined. It was defined as an ounce of gold. So you can change the definition of the dollar. And in fact, the definition of dollar did change, right? We saw in 1934, it was changed to $35 an ounce from 20 odd, almost $21 an ounce of gold. But in those scenarios, the gold was the gold, right? It was the dollar that changed. The dollar's definition that changed. So in other words, you can change the value of the currency, but not the value of that which consists the monetary standard. Right? Think about that for a second. We're talking about an objective standard, like a gold standard. So you can always change the definition of the currency, but you can't change the definition of value of that what consists of the monetary standard. I hope that makes sense. Now, again, this would only apply to an objective monetary standard, like a commodity standard, like gold. And again, this is why I spent so much time on this subject of properly defining money, because this all relates together. Now, this is also the key why gold no longer hedges inflation, right? Gold, or specifically its weight, no longer defines money today as it once did, because fiat currency, like we have today, is subjective. It's purely worth whatever it'll garner in trade, right? It's not defined and observable. So let's have let's try and nail this, drive this home with an example. Let's say $10 was defined as an ounce of gold, right? So you had in essence a gold standard, a gold monetary standard. And let's say you also owned, 10,000 ounces of gold. So if you own 10,000 ounces of gold, you'd have $100,000 of purchasing power, right? $10 times 10,000, $100,000 of purchasing power. Now, let's say we debase the monetary standard such that $20 now equaled 1 ounce of gold. Now, if we do that, basically all consumer prices inflate by a factor of 2 in terms of gold, right? In terms of the monetary standard, right? So now what costs $1, or what costs let's say what costs $10 or an ounce of gold now costs $20. But it still costs an ounce of gold, right? So it's the dollar that it's the currency here, or the dollar, that lost half its purchasing power, not necessarily gold. And not us in this scenario, right? In this sort of mental exercise, we didn't lose our purchasing power because our 10,000 ounces of gold that was worth $100,000 are now worth $200,000, right? We have 10,000 ounces of gold times 20. That's $200,000. So in other words, we are perfectly hedged. Now, this is again in sort of this gold standard or an objective monetary standard regime. This won't happen in a fiat regime. Let's see why, right? So let's just say we have a fiat currency regime like today. There is no definition of a dollar. So in theory, in order to devalue that by half, right, as we did in the last example, we need to double the quantity of dollars in circulation, kind of all else equal. So according to this theory, right, this increase in the money supply, or rather currency supply as I see it, but we already covered that. Right, this increase in the currency supply should elicit an equal response in consumer prices. Right, consumer prices should double, at least theoretically speaking. Not only should consumer prices double, but gold's price should too. But why, right? Why must this happen? Is it some kind of decree of God, right? Like, why must gold's price double? What's the mechanism that forces this to happen? Well, luckily, we don't have to figure this out because our good friend, Clark Warburton, already did. Our old monetary economist friend who's probably showed up once or twice on this show. As he observes, the first change in price occurs at the point where the additional money is introduced into or taken out of the economy and is expressed in an increase or expressed as an increase or decreased demand for the goods and services desired by the persons directly affected by the change in the quantity of money. It's a little bit of a mouthful, but basically what he's saying is when we introduce money into the economy, how that money is spent will dictate what prices go up and down based upon simple supply and demand. Now, this goes for all assets, including golds. So in this fiat currency regime example, gold's price won't automatically increase as it did in the gold standard scenario. Right, in the gold standard scenario, gold's price had to increase by a factor of 2 because of how we defined dollars. The definition was the mechanism for increasing gold's price in dollar terms. However, in this fiat case, that's not so. Gold's price might increase, but it may not. In fact, it may increase, but even if it increases, it doesn't need to do so immediately like it does in the gold standard, or even proportionately to the currency supply increase. It all depends on how people who receive the new currency supply actually spend it in the real economy. Gold's price only rises if and when people will bid up the price of gold, just like any other good and service in the economy. And again, this is different than the gold standard, right? The price in a gold standard has to increase because of the definition. Here, in a fiat currency standard, the one in which we live in today, gold's price goes up based upon people's spending patterns of the new currency that is introduced. Thus, gold's hedge for inflation is imperfect at best and potentially even non-existent. Right? Gold's price might increase, right? Gold might hedge inflation perfectly. However, in a gold standard, gold must play these roles. It's very different. And in fact, the data that I presented on last week's show seems to present this view that gold might, not necessarily that it must, hedge us against inflation. So if that's the case, where does that leave gold? Well, in my view, gold is really just another hard asset, hard asset, or really any asset in the economy these days. Really no different than real estate, art, wine, stocks, bonds, iron, cryptocurrency. For anyone who is if for anyone who recognizes this, gold seems all very Superman 2 to me. Hopefully there's others out there who've seen Superman 2, right? To me, gold with respect to inflation is kind of like Clark Kent without his superpowers, right? In Superman 2, Clark Kent gives up his superpowers and then tries to confront the bad guys, and he, gets the snot kicked out of him. And that's not because, Clark is necessarily bad. He just no longer has his superpowers and is no longer Superman. And that's kind of how I see gold in a fiat currency regime, at least with respect to inflation. Because if gold is not an inflation hedge or a great inflation hedge or a unique inflation hedge, raises the obvious question, is gold worthless? Why own gold? What are the merits of owning gold? Are there merits of owning gold? Now, in my view, and again, this is not investment advice, there still are compelling reasons for owning gold. Everyone's got to make their own decisions here, right? And there's specifically 3 that come to my mind. The first is that, gold has had strong standalone returns in certain time periods. Right? You said simply, you've been able to make money owning gold. I mean, that's good enough for me for trading in my investment portfolio. Secondly, there are portfolio effects from owning gold that are, that might be desirable. Specifically, gold seems to be uncorrelated with many other kind of popular assets and strategies. And lastly, gold still can be a store of value, just like any other asset, but still a store of value nonetheless. And it's particularly good at this when so-called real yields are negative. And I'll touch upon that in a second. So this is a quote from a study by Artemis Capital Management, research that I like to read. I think they do a fantastic job. They note that gold has outperformed the stock market on a price appreciation basis over the past 48 years since Nixon delinked US dollar-based convertibility on August 5th, 1971. And this is from their allegory of the hawk and serpent report. So that was out maybe a year or 2 ago. So, it's as of, this finding is as of that report date. But really all Artemis is saying is that, hey, we can make money owning gold, right? Good enough for me. Investing, as I've noted, is the act of making money from money. Hence, gold is just as legitimate of an investment option as really anything else in my view. Take money, buy gold, make more money later. Seems good enough to me. This is from the same study, same people, same study, but they found that gold is uncorrelated with many popular investment choices. Highlighted that in red. If you look at gold, I could have gone the other way, horizontally as well, but you look at gold's correlation factor, it's basically 0 or very close to 0, and definitely less than, mostly uncorrelated with all other popular investment choices. Look at this 60-40 portfolio, for example. Let's see, this is right here, the classic 60-40. you could see the correlation is zero according to them. And this is because it has virtually no correlation to equities, a little bit, but virtually zero. No correlation to real estate, virtually no correlation to bonds, and the same for lots of other assets. Now, this is beneficial for investment portfolios. And, if you have questions on why, I could get into that, but I won't now. And it's especially true if you can also have positive returns from your asset that is uncorrelated. So we have strong returns, right? That's what you're after, is returns in investments. Uncorrelated, we see that's uncorrelated. It's an uncorrelated asset that you can add to your investment portfolio. So strong returns and uncorrelated returns are desirable. And of course, it can also store value. Like I said, this is no different than any other asset, right? You can buy gold and it can retain a certain amount of value. Now, I mentioned that gold performs best when real yields, right? Real yields in quotes are negative and declining. And this is how professionals think about gold the most, in my view, at least how I see it in my kind of realm. Now, what is a real yield? Why did I put that in scare quotes? So real yields are it's a concept of an asset's return excluding the impact of inflation. So real yield is an asset return excluding the impact of inflation. So really how most people measure real yields is they'll take the notional government bond yield, so the yield you see, on your screen, and they subtract out of that yield some kind of measure of inflation, call it the CPI or whatever, 2% or some kind of estimate. Now, of course, I have my issues with this whole concept of real yields because I have my kind of issues with with the whole concept of inflation in a fiat regime. But this is observable, so this is a driver of gold value. And the reason why, or the fundamental relationship here, is that if you wanted to store your value in gold, it costs you money, right? You have to store that. Now, either you could buy a bunch of gold and store it, under your mattress or in your safe at home. You still have to buy that, and you're taking on some sort of risk / protection strategy of making sure against theft and making sure you don't lose your gold or it's stolen. But if you're, an institution and you own lots and lots of gold, you have to pay a professional to store that for you. And that costs money. Even if you buy a gold ETF in the market, there are fees associated with that. So rather than pay to store your wealth, a lot of people have turned to government bonds, right? Why not earn a yield on my money, right? I'll buy a bond, let's say for $1 million, and then I'll get a coupon payment on that. And I'll get the return because it's quote unquote safe or perceived to be safe. I get my money back at the end of it. So I'm earning money with my money, and it's still kind of retaining its wealth with minimal risk of downside, in my estimation in this example. Now, a negative real yield, that implies that there is, in fact, a cost to the strategy. There's a cost to kind of owning the bond in this case, because you're actually paying, just even though you're receiving money back in the form of an investment stream or return stream, inflation is actually reducing the value of that such that you're losing money. That's the theory of real yields. And if you need anyone has any questions on that, feel free to use chat function. I'll try and explain it better. But anyway, when we have negative real yields, gold then becomes a competitive. Gold then becomes competitive as a store value option in this kind of environment, right? We're now paying money in storage fees to own gold, but in theory don't have the inflation risk. And in a negative real yield environment, we're getting an income stream, but that income stream is devalued via inflation. So we can see here, this is from a study listed at the bottom, that the relationship between the gold price and real yields are pretty strong. This is just over the past 15 years. We see an R squared, or a correlation factor of 0.71, and that's pretty high. That's pretty high for those not familiar. So this is a potential framework for investing in and trading gold in this environment where, it just gives us sort of a framework to latch onto if we want to trade gold. So in summary, gold is believed to be an inflation hedge. It's definitely played that role pretty perfectly in the past, but it no longer does. This is because gold's relationship to money changed, right? In a fiat currency regime, it's different than defining money as gold. Now, this is definitional. Sorry, I lost my thought of that. Yeah. So again, gold's relationship to money changed, but also gold's relationship to inflation changed, right? How we define inflation in a fiat regime is different too. So how we define money, gold's role in money, but also how we define inflation, which really doesn't make sense in a fiat currency regime, changed, right? Inflation no longer means monetary debasement. It means change in basket of goods. So these are definitional changes, but they're not semantical. They actually mean something. And this is a very important point. So absent gold's special role in money, it's just another asset. And in my view, the data support this perspective. But to be honest, I'm pretty unsure of how much of gold's value today is really due to its inflation hedge legacy rather than reality. Now, none of what I've said, as I've stated, is not a defense of fiat currency or a statement against owning gold. Now, again, this is not investment advice. These are just my observations. So do your own work and take it or leave it. But my purpose here is really just to raise awareness of another rationalistic investment belief that many people kind of hold, rarely question, and we just kind of all take it for granted. And challenging these types of beliefs are really the theme of my entire show. That's what I've been trying to do here over the past 9 months or so. Because the better we can determine what something is, the better we can speculate on what we ought to do. Right? This is ought investing. So with that, I am going to wrap up my season 1 content. It's been a heck of a journey. Thank you, everyone, for coming. I'm going to hit this, check the chat in a second, but I'm going to be back next week with a sort of season 1 review. I want to look back to gain some perspective on kind of where we came over this journey, because I find it always interesting to just to look back over the path you've traversed, see, if you can glean anything or any mistakes. And also too, hopefully I won't ramble on too much, but, I'd like to open it up a little bit more to an Ask Me Anything type of show. So if you have any questions that you haven't asked, feel free to ask me there. Of course, I won't be doing any investment advice. So we're going to be talking more conceptual questions. But, happy to take it or leave it. I'm pretty good at knowing my boundaries. So with that, I hope you enjoyed it. Check the chat here. MA, thank you very much for your super chat donation, as always, or both of them, I should say. Thank you so much. Enric, I hope I pronounced that correctly. I'm sorry if I did not. Is anything an effective hedge to inflation? Is anything an effective hedge to inflation? Now, again, I think it depends on what you mean by inflation. If you're going to say, is anything an effective hedge to changes in the CPI? I mean, I would say no, because what is the CPI? It's a basket of goods and services. I don't know how many items are in the CPI. There's all these kinds of adjustments, right? Some things are moving up, some things are moving down in the CPI. It's really nothing that you can hedge against. I mean, if you were really interested in just neutralizing CPI changes, you can, try and trade to best effectively all those components. And in fact, a lot of people try and do this. There's a big contingency of people who try to trade inflation via the oil impact, because the oil price, because the oil, is an input to a lot of goods and services. So I think it may almost be like 70% or 70% correlation. Don't hold me to that, but something like that. So people try and speculate on changes in CPI via oil. I don't know how effective anyone is at that or not. But if you mean, is anything effective in hedging against what I would call the deleterious effects, the negative effects of owning fiat currency, which I think is really the base of your question, I think absolutely there is. Now, nothing is going to be perfect, again, because of how we define fiat currency, right? There is no definition. But if you can own assets, right, so the less currency you would hold, right, because a currency is what's subject to devaluation. Again, we're going to talk very loose terms here, because it's weird. Things get weird in fiat currency. But if you own assets, right, if you own a company, if you own, bonds, real estate, gold, iron ore, I don't know, the food truck, all sorts of things that would be exchanged for on the other side of currency, those things can potentially protect you if the value of a currency goes down somehow. Now, there's also going to be other impacts to it too, right? Like we see with gold, like we saw, let's say with, I don't know, let's say iron, for example, right? There's other supply and demand drivers of all those other assets. There's supply and demand drivers of stocks. There's surprisingly enough, there's supply and demand drivers of gold. There's supply and demand drivers of real estate, supply and demand drivers of iron. There's all these, they're all idiosyncratic to the asset class or specific asset. So there's another component layer where you cannot perfectly hedge inflation, because there's something else going on in the supply demand component of the asset, not related to the currency, but the currency does intertwine there, does play some kind of role that's unquantifiable, or maybe very, very specific to the case that we can't really generalize on. So I hope that helps. All right. So mouthful. I hope this was enjoyable. I hope we really got into gold. We see kind of where its virtues and where its vices are, and we have a better understanding of it. I have a better understanding of it personally. I now think of it differently, and I own it in my investment portfolio in a different type of thesis. I hope everyone has enjoyed the show. If you can, give it a thumbs up if you liked it, share it as always. And, please join me next week live as we wrap up season 1, kind of ask me anything, kind of view the journey where we've gone on. And, really just let's be honest. We're going to slide into to the end of December, which personally is one of my favorite time of years, the holiday season. Absolutely love it. So with that, everyone have a great weekend, and I'll see you next week.